Welcome to our panel discussion. On behalf of KPMG, thank you for this wonderful opportunity. I'd like to have all of the panelists to just quickly introduce themselves, give some background on their firm, and also in one word, if you can limit it to one, describe venture capital today.
Hi, my name is Alex Bangash, and I'm the founder of Rumson Consulting Group. We're an advisor to endowments, foundations, and sovereign wealth funds, helping them invest with venture capital. I'm also the founder of Trusted Insight, which is a platform for institutional investors. Think of it as a Netflix for LPs, which is also in a fund of fund. So my one word would be structural change.
That's 2 words.
Yes.
Okay. Change. I hyphenated.
We're innovative here. Good morning, everyone. Good to be here. My name is Nicole Belichko. I work with CM Capital. We're a single-family office based in Palo Alto. We advise a Hong Kong-based Chinese family, but a little different, I think, than most in that the family set up operations in Silicon Valley in 1969, and we've been investing in venture since 1981. So we have a portfolio of VC funds that's been constructed over the last 30 years. The word that I chose was heated. I didn't want to say overheated because I think there's some interesting things going on today, but it's definitely a pretty heated market. And that's one word.
Thank you, Nicole.
Hi, my name is Corinne Geltfeld. I work with Abbott Downing at Abbott Downing, which is Wells Fargo's ultra high net worth group. It's national. I'm based in San Francisco. We cover, we invest across all the illiquid asset classes. I personally cover everything that's not traded, including venture. I've been at Abbott Downing for a couple of years, but before that managed an alternative investment portfolio for a big pension fund. So I've got that kind of more institutional background. And there, we are also based in Palo Alto. It was at HP, had quite a lot of exposure to venture in particular among the asset classes. So.
What's your word?
My word, thank you. Dynamic.
Nice. Hi, good morning. I'm Mark Riegel. I'm the Director of Investments at Briar Hall, which is a single-family office. This is my first foray in the institutional, the taxable investor side. I've always worked for tax-exempt institutions or had tax-exempt clients. Before, I worked at DLJ and Credit Suisse in their customized fund investor group for many years, and then started a firm called Arborist Capital. So my one word to describe venture would be minefield.
Okay, so we have a heated, dynamic, changing minefield. So let's get started. I hope you guys get more information as we continue with the discussion about why they feel this way. So I'll start with some statistics. According to Cambridge Associates, the average annual return for venture capital over the past 10 years has been 8.1%. However, the top quartile generated 23%. The top 20 firms out of 1,000 firms have done better and generated approximately 95% of the industry's returns. Corinne, based on this, why would you ever invest below the top quartile?
I wouldn't.
Elaborate, please.
Okay. I guess I wouldn't, and it depends kind of how long back you look at track record, right? I don't think that one fund is necessarily a measure, but for those firms, and this is especially true from my experience with the HP portfolio, you necessarily didn't know where the next Google would come from or YouTube or any of the successful exits, but with a high degree of certainty, you knew it is likely to come from perhaps 5 of the many names that we had in the portfolio. And so, in principle, what I took away from that experience is that it is the top quartile and arguably the top decile that I would personally pursue and for clients as well at Abbott Downing. But I will I will note that on occasion, there is sort of a breakout fund, a breakout structure, things that merit kind of taking a look, and it's not always going to be the old guard, but, I mean, if, you know, don't fix it if it ain't broke. I mean, those firms that have generated and continue to generate those kinds of returns are great. The problem is access, of course, but,
Okay.
yeah.
I know you want to speak, Alex. What do you think?
Yeah, so I actually vehemently disagree. And the reason I disagree is that I think this is one of this perception of top tier as unchanging list of firms that generate all the returns is actually a myth. And it's perpetuated by two people. One is the incumbents, which don't want to take the chance, they have career risk. And the second is our asset management structures, the fund of funds, are actually selling access to these names for which they can then charge fees, the asset gatherers. What's actually happening, and this harkens back to what Peter Thiel was saying, what actually is happening is that the venture industry is much more like Apple or Google than it is like a Coke or a Pepsi. It's not a brand. These structures are changing. They're becoming global. The financing structures are changing. So the way you get the best returns is when you are actually able to identify these new structures that are becoming relevant. Okay? Today, Paul Graham has a better brand amongst entrepreneurs than so-called your top tier VCs that VLPs are familiar with, right? But most of us don't have access to him. Similarly, funds that were not known, Union Square, First Round Capital, they're all new structures, innovation structures. And the big news is, and this should make us, this is the minefield. Going forward, the rate of change of these structures, new disruptive structures in venture capital, is going to increase. So in the 70s and 80s, these new entrants would come once every decade. It started once every 5 years, but going forward, it's going to be every two or 3 years.
Mark, what are your thoughts?
I think what Alex is saying has some merit to it. Things are evolving, but I think that's why I utilize the word minefield. I still believe that there is a steady state of premium deal flow that persists throughout the business cycle that inures to the benefit of, take your partner at Sequoia or Accel. Yes, those organizations are evolving, and I think some of those organizations are being more smart about how they evolve and maintaining their relevance as the industry changes. But so I wouldn't dismiss, there still tends to be a significant amount of persistence in returns among those top 5, top 10 groups. I'm not ready to dismiss them quite yet. This, with the exception maybe of a couple of the newer funds, they have done well. Whether or not they'll continue to do well, I think there's some debate with respect to whether or not a rising tide has lifted some of those boats. But we haven't gone through kind of a full cycle yet where things are kind of normalized and comparable. So I'm a big proponent of looking at new names, and I certainly have backed new names. I kind of I like to call it the Peter Dolan approach to kind of seeding new firms, knowing the fact that not all of them are going to work out, but maybe if you back couple new names a year, you're going to have an opportunity once there's kind of maybe a shakeout. Some of them work, some of them don't. You're going to have the opportunity to have large allocations and pro rata rights maybe in their funds going forward. So being able to renew the portfolio on a regular basis, I think, is important. But I'm not ready to throw all the kind of, shall we say, more firms that have been around for quite some time. I'm not ready to throw them under the bus like Alex is quite yet.
And I'll take those allocations, Alex.
Nicole, I know CM Capital has revisited the portfolio and has been looking at new funds. Can you elaborate a little bit more on that?
Sure, yeah. So the way we think about portfolio construction, I think similar to Mark, is we have a couple of core managers in the portfolio that some of them have been there for 20 or 30 years. And some of them have persisted, others have not. And so it's a difficult business. These are small firms, they're like small businesses as well, and some of them have faded away over time. And that's, I think, just the evolution of the cycle. But in general, we've continued to back with as much allocation as we can to a few of what we believe are the top 5 or top 10, and we've concentrated our portfolio with those positions. But around that, we've also taken the opportunity to make new investments over time. I've been at my firm for 9 years, and we've made 7 or 8 new investments over that period. Some examples, we went into emerging markets in 2005 to 2007, and we placed some bets and some funds there. Some of those have done quite well. More recently, we've looked at some new early stage and seed groups, and we made new commitments in 2013 and 2014. And we did a few in between there as well, post-financial crisis. So we continue to look at new managers. We like to look at new managers who have track records, and preferably, again, strong track records. So they show that they've made the transition to being an investor and can be a steward of our capital. And so that's how we've thought about creating the portfolio over time. And not all the managers that we've backed over the past 10 years have worked out, but we believe enough of them have that they continue to bolster our venture capital portfolio so that we can reach the desired position in our portfolio that we'd like.
Alex, you talked about some new structures in the industry. Can you elaborate more about those new models in venture capital that are working well for returns, and what are the value-added activities that our GPs are adding and providing that are beneficial, and maybe some that are not as valuable?
So one of the things which has actually happened, this goes back to what fundamentally venture is. Venture is actually money plus services. And these services money is a commodity, so services really differentiate venture capital firms. And these services can either be delivered artisanally, or they can be delivered in a platform manner. And a platform is one which can deliver services at scale, consistently, and has network effects. So that's why at Trusted Insight we're building a platform. First Round Capital is a platform that provides services to early stage companies, seed companies. YC is a platform. Sequoia itself is developing a platform. So we see platforms as being one of the most disruptive new structure and a model. Surprisingly, LPs have now started investing in micro VCs. And micro VCs, we helped our clients, and we invested in micro VCs in 2007 to 2011 and 12. They are today at a structural disadvantage. So people look at the track record and say, oh, gee, well, these guys will do great. But they are at a structural disadvantage. They have low barriers to entry. They don't have enough capital. They don't have things. So they are at a disadvantage. Another thing which is at a disadvantage are firms that are vertically focused. And Peter Thiel also mentioned, because LPs have been burnt time and time again. They invest in medical device funds, medical device turns thing. They invest in clean tech funds, clean tech sector turns. So we are not smart enough to pick sectors, right? We can pick managers. With platforms, you get the ability to invest across, you invest horizontally. Increasingly, these platforms will also become online. And that's the next bet that we're taking with Trusted Insight.
Do any of the other LPs on the panel have any thoughts on some of the new models of venture capital and what's working well?
I mean, I think the interesting thing, and everyone sees this, is there's a lot of more sort of high net worth funding through things like Kickstarter and other associated firms or other similar firms. And so I think what that's done, unfortunately, I think people think it's positive, but unfortunately it's also put a lot of pressure on valuations for seed and early stage. And so if you have, I want to develop a new cup widget, and I take my pep widget on a Kickstarter and I raise, $1 million and I build it, I have a proof of concept at that point and I'm selling it so I have revenue. And so instead of going to a traditional early stage firm and saying, I have an idea, I want to raise, $1 million at 5 to 7 pre, I say, I have sales, I have $500,000 or $1 million in sales. I want you to give, I want to raise, I don't know, $5 million to get me to the next level, and I want a $40 million pre. And we've seen that more and more. And I think venture firms are willing to take the risk because they see the potential growth and they actually see revenue and they actually see a product for the first time. But that's fundamentally, I think, disrupting the system in terms of how the model works and what will happen in terms of the value chain. And so it's incumbent upon the market to make sure that these firms grow fast enough to justify those late stage valuations, or not even late stage, they're usually Series B or Series C valuations, and I think that remains to be seen. But I think that's one of the biggest disruptions that we've seen in the market, and a couple of our VCs have told us that the sort of seed and also the crowdfunding model has really changed how they think about the business, how they source deals, and sort of the metrics that they're looking for.
Nicole, why should that same model disrupt at B and C or even the growth? So it can also as easily disrupt growth investing.
It can, but you need a lot more money. I think, when you have $1 million check, you can easily raise that from a handful of individuals. When you get to, financing, when you get to growth, now you see, I need marketing. Like, I need big marketing dollars. I need to raise 50 million. I need to raise 75 million, because you're seeing that sort of growth stage round in today's environment, and those are huge checks, and that's another place you see a disruption in the model.
Yeah, which is like GIC investing
Yes.
in Square.
In Square, yeah, exactly.
Does anyone else have comments on valuations just being out of control, and how are smaller funds successful in this type of environment, and what does it mean for you as an LP? Any thoughts?
Valuations, we have, there's been a lot of talk about valuations, I think, over the course of the last few weeks, particularly how much money is being raised, at what valuations, burn rates, and I think obviously caution, I think, been raised. It has started to creep into our decision-making processes. At our firm, we predominantly invest through funds. We do some other type of structures, but we have started to turn things down, just looking at kind of some behavior of some of the underlying managers that we're seeing in terms of what they're valuing things at, and what they're underwriting things at. So, and that's both on the venture side as well as, I think, the buyout side. So. I don't know. It's a concern, and it impacts our behavior a little bit, but it's not going to really drive our kind of capital deployment pace, or who we're going to put money with, at least at the top echelon of the venture chain, because I can't really walk up to, I don't know, whoever it might be, take your pick, Peter Fenton, and say, I'm going to sit this one out because I think we're at the top of the market. I mean, my goal is try to gain access to the best names and invest with them throughout the business cycle, and recognize that some funds are going to do better than others because the entry points that you're getting into and the exits environment is going to be different from a timing perspective from each fund. So, and just hopefully from, developing those long-term relationships, you're going to generate outsized return over the course of a number of different funds. So that's my philosophy.
The most experienced funds tend to draw the capital down over 4 to 5 years. And so if you commit today, you're investing through the cycle. I think the troubling thing is you see a lot of funds being raised now and they're putting money to work in a year or a year and a half. And that's where I think it presents a challenge where you can time the market or not time it.
Yeah, but I think that's the title of this panel is what? Will it last? Of course it's not going to last. Anyone who thinks it's going to last is their head in the sand. So it's not going to last. But my goal as an institutional investor and as a fiduciary is to generate the best returns possible over the long run. So I'm not trying to, I don't have any clients that I'm have to fundraise 5 years from now and make kind of irrational decisions about, because I've got one client and they've been investing for the last 25 years, and they're going to continue to invest. So it makes things a little more pure, I think. So.
But in some sense, we are at the mercy of the managers, and the managers themselves are at the mercy of the heated environment. So Airbnb and Instagram raised money at 1.9 million pre-money valuation. Can you get that? No, that's not going to happen. Now they're raising at 20, even $40 million. They're raising Series B. I'm not going to name the company. A company raised Series B that was started in 2013, $60 million Series B. And you have these name brand funds in it. So whether you like it or not, you can say we're investing with the same funds. Well, they were coming back to market every 3-4 years. Now they're coming back to market every 12 months, raising growth and opportunity funds. So in some sense, we are at the mercy of the markets.
Yeah, and you saw the same thing, at least for our folks that have been around, in the late 90s. I mean, the same thing. People were raising funds every year.
Yeah, and those were the best names in the market as well. So nobody was, nobody was immune to it.
Right.
Okay, so Fortune released an article last week, and it opened with, "Is now the time to double down or to slam on the brakes?" And I'd like to close with that question with each of you, if you can say one way or the other, and why.
It's irrelevant. I try to invest the same amount of money I can throughout the business cycle, try to put the same amount of dollars to work. It's difficult because a lot of groups slow their pace down when the business cycle, throughout different points of the business cycle. But I'm not trying to double down and time markets. I'm just trying to put a consistent amount of money to work throughout the business cycle. So, I mean, that's all.
I would echo the prior comments that you guys made as well. What I would say is that on the margin, we may make more niche-y bets. Like we recently backed a fund that's a third-time fund. It's small and it's kind of under the radar, but they're pursuing clean tech among other opportunities because clean tech is kind of not favored and a lot of capital has retracted. That actually seems like an interesting opportunity. So we will try to kind of look across the macroeconomic environment and kind of see if there are any spots, any areas that are kind of overlooked. But outside of that, especially in venture in particular, I cover all the asset classes. It's really, I mean, distressed debt might be an area where we might double down and then withdraw, but it very much corresponds to what's happening. You really, like I said in the very beginning, it's hard to predict where the really next huge big success would come out of. Although, again, like I said in the beginning, there's some places you could guess that it might come out of. Can't guess the time. So we probably similar approach in the top tier kind of venture, first quartile venture investing.
Nicole, you're nodding.
Yeah, I mean, we don't think about a venture allocation per se. The way we think about it is we try to get as much allocation with the core managers in our portfolio regardless of when they come to market. And that's consistent across any vintage year. We're not going to scale back from Mark's comments because we think it's a bad year. We're going to take as much as we can get and work to get that increased. And then sprinkled around that, we'll do a small number of undersized positions, which will scale up over time if the fund continues to be successful. But that's what we do. And if it's a small amount of capital in any given year because there's not a lot of fundraising activities, it's a small amount. And if it's a large amount because our core managers are all coming back to market, we would still budget for that and commit accordingly.
So yeah, I do look at the world differently. We do, of course, our clients will go with the top managers where they'll get the allocations. Or we look at this opportunity, we'll say, what can we do to actively reduce our exposure to this overheated market? Because that's the most important thing you can do. And then we look at whether they're different geographies or different structures. So structurally, if you can be in a part of the market, whether it's seed or it's a different geography, where there is not as much capital intensity, and you have a deterministic, I mean, why do we want to invest with the so-called top tier? Because we have a deterministic outcome. If we can get that deterministic outcome somewhere else, that's where we double down.
Well, please join me in thanking all our panelists. This concludes our discussion. Thank you.